What's up, Squares? Harold Perkins here, and today I'm going to share with you the answers to your mortgage questions. These questions come to us from people who are getting ready to apply for a mortgage, or they just want to get a second opinion on information that they've gotten from their mortgage broker. We're here to help, so if you have any questions, you can message me on any of my socials or ask your questions in the comments below. And the best questions of the week get answered right here. The first question of the week comes from Fatima in Arizona, and she asks, "We've both worked for the same casino for almost 10 years. Everything was fine with the loan until they asked for a 2020 W-2s, and then they denied the application because we didn't work enough that year. They said the only reason they denied our application was that we did not have 2 straight years of work history. The question is, do all mortgage companies have the same criteria, or should we apply somewhere else?" You absolutely should apply somewhere else. Obviously, if you worked in a casino in 2020 and your income was light for that year, it was due to COVID. So yes, there are guidelines that state you have to have a 2-year employment history to qualify. However, all loan programs have specific guidelines and special consideration in place on how to handle income and employment history for borrowers who have been affected by COVID. In your case, you worked several years before COVID, had a gap during COVID, just like millions of other people, and then have been back to work several months after COVID. This is okay. The worst that should have happened is that the underwriter asks you to write a letter that states that your income was low in 2020 due to COVID. Now that we're about 18 months after the shutdown, I think it's more likely that there's no questions asked. Everybody knows that COVID happened. So don't give up, talk to another mortgage broker, and I think you'll be fine. The next question comes from Michelle in Oregon. I picked this one because it's similar to Fatima's question, but the problem is a little bit different. Michelle writes, "We didn't work from March of 2020 to January of 2021. We are in the restaurant industry during COVID and it's dragging down our average income. Is there anything I can do?" So what Michelle is talking about here is that when you have variable income such as tips or commissions, the underwriters will calculate that income by taking a monthly average of your tips over the past 2 years. Well, that can be a problem if you were out of work for 8 months and didn't receive any tips because your restaurant was shut down because of COVID. But there are considerations that can be made for you, Michelle, because chances are you were not the one that caused the global pandemic. You're not going to get penalized for that. Underwriters can look at your tip income prior to COVID and compare it to your tip income after COVID. If the amounts were comparable, then the time that you were off work can be excluded from the income calculation. Or in most cases, the underwriter can make the decision to just calculate your income for the time since you've been back to work. It just has to be more than 12 months since you've been back to work, and then in your case, it's already been 18 months. The same advice as before, don't give up, talk to a different mortgage broker, and I think you'll be fine. So far, 2 very good questions. If this information helps you, or if you know somebody that's had similar issues with their mortgage application, please make sure to hit the like button so more people can get help from videos like this one. And please make sure you stay to the end of the video so that you can see the question of the week. Next question is from Rob in Washington. He writes, "My fiance and I are currently in the pre-approval stage for an FHA loan, and my parents wanted to gift us the money for the down payment. However, my name is not going on the loan. Our lender is saying that my fiance can't receive the gift money from my parents. Is this right? Is there anything I can do about this?" Rob, this is not right. FHA pretty much allows anybody with an established relationship to the borrower to gift the funds for the down payment. This would definitely apply to a future daughter-in-law. FHA even allows gift funds from friends. You don't have to be family. As an example, we had a loan a few years ago where the borrower's best friend was the one that was gifting the money for the down payment. They happened to work together with the same employer. So the way that we documented that they already had an established relationship was that we did an employment verification on the borrower's best friend. When we saw in the employment verification that they had worked together for years, that's all the documentation we needed, no further questions asked. So Rob, what I would expect in your case is that all that would be required is a letter from your fiance that states that your parents are her future in-laws. That'll take care of it. The only people that are restricted from gifting the down payment on a loan are the people that have an interest in the transaction. For example, the realtor, the seller of the house, or the mortgage company cannot gift the funds for the down payment. Now, the gifting rules are different for FHA loans as compared to conventional loans. Conventional loans require that the person giving the gift be a family member. And now it's time for the question of the week. Now, this question was sent to us anonymous, but it's a good one, so it makes our question of the week. The question was, is buying points on a refinance worth it, and how does that work? Well, this seems like such a simple question, but it has a very complicated answer, and the answer is different for everyone. Well, let's start out with, what are points? Well, points are the fee that you pay in addition to your closing costs in order to get a lower interest rate on your loan. Well, the more you're willing to pay in points, the lower your interest rate will be. But having the lowest interest rate is not always the best thing for you. Now, this seems really counterintuitive. Why wouldn't you want the lowest interest rate all the time? Well, let me give you an example. So let's say you can get an interest rate of 5.5% with no points, but you're also offered an interest rate of 5.25%, but it has $3,000 in points. Your payment at 5.25% would be $60 a month lower than it would have been at 5.5%, but the cost for that 5.25% is $3,000 higher. So if you divide the $3,000 cost by the $60 a month savings in the monthly payment, what you'll find is that it takes 50 months before the lower payment saves you what you paid up front. It's over 4 years. But what if you think you're going to sell your house in less than 4 years? If that happened, then you're actually worse off for having paid the points to buy down the lower rate. Or what if rates go down to the point that it makes sense for you to refinance your loan into a lower interest rate? Well, the same thing happens. The points that you pay today to buy down the rate only benefit you if you stay in the loan long enough to recoup those costs. Side note, points work the other way too. You can choose to take a higher interest rate and then you'll get a credit to your closing costs. That's how a no closing cost loan works. And those are the mortgage questions of the week. Thanks for watching. We're here to help, so you can ask your questions in the comments below or message me on any of my socials. Best question of the week gets answered right here, and you can watch my other Q&A videos right here too. Later, nerds.